But right now, let's get into our next conversation. Madhav Dhar, managing partner at GTI Capital Group, is with us. Madhav, good morning. Thanks for joining us on Trading Hour. So it's been quite a journey for the market, right? We are looking at fresh all-time highs. We are talking about almost 40,000 on the grand old index. But there are still some nerves out there in the broader market, you know. Just your sense on the rally, whether you think the worst of the mid-cap correction is over and whether you think we're actually good to build from here.
I guess, yeah, a couple of points. Firstly, you know, it's obviously, I mean, I hate to sort of de-Indianize it, but the S&P hit all-time highs and everything else is getting dragged along with it. So the most important factor remains the U.S. Fed and the U.S. stock market, and particularly tech, and the narrowing of the global cycle in terms of leadership. The same thing is happening in India. And as you said, the mid-caps took a big correction and a big beating. Hard to say when it's all over. I mean, obviously, a lot of damage has been done, and they're sort of picking up a little bit. But you're still about 80% above the long-term average trend of the mid-caps. So it's still expensive and still extended. So it's hard to say exactly what will happen there. But the Indian cycle continues. I mean, the good thing about India is that it's starting to accelerate in the last year. And so even though there may be some global dampeners in terms of the Fed hiking, the US bull market being very old and extended, the Indian economy is finally starting to pick up and accelerate, and there is some movement on bad loans, and there's some progress there. So it bodes well for an investment cycle picking up and for us in India to have a longer cycle. So it's a mixed bag, but it's broadly encouraging. Having said that, if and when a U.S. correction hits, it'll take everything down with it.
Mm-hmm. Madhav, hi, morning, Prashant here. So then what is the right way to sort of looking at everything together? I mean, so keep a wary eye on the U.S. market, etc. By the way, you know, I was reading a Credit Suisse a note yesterday which said that U.S. market valuations from a year ago have actually gotten cheaper because earnings estimates for the S&P 500, for example, have gone higher. So, is that, I mean, how do you, I mean, put all of it together and tell us what's the right way to look at things?
No, listen, you know, I think, you know, I'm very boring as far as TV is concerned, as you know, in the sense that I think the stock market is not a trade and it's not a stunt. It's a long-term commitment to the idea that you need to be broadly assigned with the growth assets. And there are fewer clear growth assets I see in the world than U.S. equities and Indian equities, frankly. And I'm not saying this because I'm Indian. I'm saying this because the structural underpinnings of long-term growth in India seem extremely solid to me, despite the hiccups we have. So how do you invest in something like that? You invest in never selling. That's how you invest. And every time there is a big hiccup, you buy more if you can. Honestly, that's the way to do it. It's very hard to second-guess stops. It's much easier to pick bottoms, and you should try and do that. And the reason it is because fear is instantaneous and more extreme, and greed is slow and cumulative. So market tops are very hard to stop. Market bottoms are much easier to stop. So if you have a structural long-term trend and you're doing one of these, every time it looks bad, you should buy more. That's the way to do it, and not get out of what is a multi-year trend. And there's very little doubt, Prashant, I know I've sounded boring. I've been saying this for decades, and I find India the same way, that there'll be periods where there is stress in the system, and the high to low correction may be 20%. By the time you sell and buy back, you're going to miss half of it anyway. So this doesn't bode well for brokers or breaking news, but that's the way to do it. And the point I'm making, which is more of an intellectual one and not an action point, is yes, we are late in the game. Yes, valuations are extended even though earnings are rising both in India and the US. You're 10 years into a bull market in the US. The economy is extended. The Fed is starting to raise rates. Leadership is narrowing. And those tend to be late cycle, that's a late cycle phenomena. So there's little doubt in my mind that we're in a late cycle phenomena. Whether it lasts another 6 months, another year and a half, there will be a recession and the markets will correct sometime in the 18 months. And there's sort of little doubt in my mind. The question is, do you anticipate that? Do you act ahead of it? I'm not sure yet. You may go into a blow-off in these tech stocks, sort of like you had in 2000, sort of like you had in 2008 early. So if it becomes visible that something is going truly crazy, you can take some action.
Okay,
But
Madhav,
that's
allow
always the
me,
case.
allow me to intervene because you made some very, very interesting points there. Do you think that this could be perhaps building into a 2000-like situation as far as US tech goes? And I mean, you're saying that you're convinced that 18 months down the line, we're looking at a recession. So even in India, is this a late-stage rally then? Then would you not be looking at buying what's already run up? And in India, we know what runs up. Private sector banks will run up. Consumer stocks will run up. So then, how do you play this?
Yeah, no, you're asking a very important and very difficult question. Yes, I think you're probably right. I think you don't necessarily want to chase that. But what happens in late stage is what is working becomes a momentum trade. I mean, like you're seeing it in the US, that you narrowed to broad tech, then you narrowed to big tech like FANGs, and last night you had a big move in the market and only Amazon was up in the US. So yes, I think that what has worked, which is high quality private sector banks, or are at very expensive valuations, you know, tech, banking, credit in general has done fantastically. Everybody knows that's the big secular growth story in India, which I happen to believe, but it's done extremely well, everything from HDFC to Bajaj Finance and so on. And by temperament, I tend not to chase those things, but it's hard to say, because when you go into a blow-off, the things that are already extended get more extended. It's not the rational thing that happens, it's the momentum trade that happens. So yes, I think it's possible that you go ballistic, that you go vertical, and it's too early to short or too early to get too skeptical about these things, because the broad underpinnings of investment psychology and earnings momentum, which are not to be sneezed at, are very solid, very solid.
Okay, so Madhav,
So I think it runs longer.
It runs longer. I mean, if you were to put money on it, how much longer before? You know, 10%. These regular corrections are fine. I mean, you know, when they come, well, everybody starts to panic, and it'll be no different the next time as well. But the one that I'm talking about is a big one. You know, we've not had a big one since 2008. So, how far is that, according to you?
I mean,
you don't see a big one.
I don't see a big one. No, no.
That is reassuring.
I think 2008 was so devastating. Big ones will only happen if economies completely unhinge. So I see the U.S. economy correcting, the Fed, but the unhinge has already happened. I mean, even though we've come so far, I mean, don't forget that from the S&P from 2000 peak only surpassed its peak, you know, a few years ago. So for 12 years you were sidelining, although it didn't look like that because we went straight down and straight up. So no, I don't see a big one at all. I mean, I think the world is in a much more solid place, and frankly in a desynchronized place, in the sense that Europe is still flagging, the US is overheating, India is starting to pick up, China is starting to slow down. So for the world in aggregate, that's sort of a healthy thing. Although your country picking and stock picking, it becomes more important, but systemically, the world is a safer place where cycles are desynchronized.
All right, Madhav, thanks very much. It's a pleasure, and appreciate you joining in with that perspective on the markets. As always, Madhav Dhar, not boring at all, I meant to add, and very clearly saying that he doesn't foresee at least a really big one, let's put it that way.